Welcome. My name is Bronson Hill. I'm the CEO of Bronson Equity. We have about 200 million in multifamily assets. We've also ventured out into car washes and ATM machines. Some reasons for that. It's been really exciting to work with investors to create predictable cash flow streams through our investing club. We have Adam Taggart joining us from Wealthion. He has 241,000 YouTube subscribers, interviews some of the top minds in finance. So welcome, Adam. How are you?
Oh, I'm great. It's a pleasure to be here, Bronson.
Good to have you here. We have Russell Gray, the co-host of the Real Estate Guys, Education for Effective Action. I attend a lot of their events, including their event in Belize. I just got back from Belize, but they have an event in June that's an investor summit that's exceptional. Russell, how are you? Oh, it looks like you're on mute there. I've got to unmute you, but we are here. So.
Oh yeah, sorry, I'm here. I'm a radio guy. I don't know how to work the mute button.
Oh, you're good. That's great. And we also have David Morgan. He does the Morgan Report. He's the author of several books, including the Silver Manifesto, and he writes and consults hedge funds and investors about precious metals. Welcome, David. How are you today?
I'm well. Thank you for having me.
Awesome. I know your background before. You had San Francisco in the background, and now you're back home. So it's good to see you back. Right. Awesome. Awesome. So we've had most of you on this panel before, but we create these events to really create a conversation with great minds around interesting and important topics that are very practical when it comes to investing. So we're going to kind of go around with this because this is a question I think a lot of people are wondering. But right now, it seems like the biggest uncertainty, at least that I see, is really what is the Fed going to do? And the Fed, it's gone from the Fed being part of kind of the investing landscape to really they're really driving the show. And so, let's just kind of go around and say, what do we think the Fed is going to do, and how does that affect our investments with rising rates? I mean, there's a lot of different ways we could go, but let's just start with Adam. Maybe you can give us a little bit of a background, kind of where we're at and kind of what role you see the Fed in having in finance right now, and when investors look at investing into assets.
Absolutely. And just to remind folks, sort of my day job is that I talk to lots of experts in the economy, experts in the monetary system, key institutional investors, stuff like that. So I'm not so much of a guru as what I do is I talk to a lot of gurus, and then I try to process what they tell me. So I would say, ask any one of these guys individually, they're going to say, look, nobody has a crystal ball. Of course, they all have their opinions. I think the general consensus from the folks I talk to is the Fed is committed in its mind that its priority number 1, 2, and 3 right now is to bring inflation under control. And it's going to do, in its mind, whatever it takes to make that happen. And that, as Jerome Powell has been trying to prepare the markets mentally for, is to say, look, I'm not going to stop until inflation gets down to where I need it to be. And that's likely going to take the course of a few more rate hikes. And then a pause. Powell's trying to kind of guide us that he's going to hold interest rates up there for probably the rest of the year, actually, before he starts bringing them down. And bringing them down, that's what a lot of people refer to when they say the Fed's going to pivot, right? The Fed's going to change monetary policy from tightening to easing. Now, the market doesn't believe Powell. There's been a big game of chicken going on pretty much all the past year plus, but certainly since October, as the market's been recovering, where Powell has had to many times come out and say, no, guys, I'm really, really serious. And the market said, nah, I don't really think you are. And what's interesting is financial conditions are actually looser at this point than they were when the Fed started initially hiking rates back in March of last year. Obviously, that's not what the Fed wants to see. The Fed has this dual mandate about price stability and employment. Well, look, employment is down, close to all-time lows. The Fed has very actively said it's actually trying to cool off the jobs market. We've had way too many job openings per job applicant, and now that we're beginning to see this big inflation, there's been rising wage inflation pressure there. So Powell is desperately trying to bring that down. So, like these blockbuster reports like the last jobs report we got the other week, that's exactly what Powell does not want to see, right? So Powell is basically looking at all this data and saying, this just gives me even more runway to keep the pedal to the metal and to keep hiking and to keep tightening. So anyways, in their mind, the Fed is committed to this. Now, a lot of the market and a lot of, or not a lot, but a number of the people I talk to think that what's going to happen is that the Fed, by hiking and tightening as fast and extremely as it has, the Fed is going to quote unquote break something. There's going to be some systemic instability in the system that really the wheels start coming off. It might be an event in the credit markets. It could trigger the Fed's pretty, I think, okay with the markets going down. It just wants them to go down in an orderly fashion. If they start really cascading downward hard, maybe that's something that would force the Fed's hand. If unemployment, not only starts rising, but starts spiking, that might be something where the Fed says, okay, we went too far. And so anyways, what people think is going to happen is the Fed's going to tighten till it breaks something. Then the Fed is going to scramble to ease and start bringing rates back down again and whatnot. The market is interpreting that pivot as, oh, really bullish. Like, we're going to go back to the great days that we had from basically 2010 to 2021. I and a lot of people I talk to say, look, if the Fed is forced to pivot by an event like that, it's going to be like a gun to the head, moment for the Fed, where even though it wants to keep rates high, it's going to have to start bringing them down. If it's under those type of conditions, those are not going to be conditions that are going to be bullish for stocks. That's going to be like a real crisis in the economy. So long-winded way of saying, the Fed is going to hike until otherwise forced this year to start bringing rates down. Most of the people I talk to think that in this game of chicken between the markets and the Fed, the markets kind of have it wrong right now, that they are hearing what they want to hear. Whenever Jerome Powell talks, they don't believe he's going to have the backbone that he probably will have, and that if he does pivot, the market thinks it's going to be for bullish reasons, or it's going to be bullish for stocks. Most of the experts I talk to think, no way, it's going to be a crisis, and it's probably going to be very bad for investment for assets.
Right. It is interesting. We've gone from having kind of recessions and boom times and recessions to now it's stimulus and then crisis. Right. So it kind of seems like that's a perpetual thing that goes on. David, give us your thoughts. What are you seeing right now? Obviously, in the economy. I know you're a precious metals guy. Talk to us about do you see similar to kind of what Adam shared? Do you have a different thought or anything you wanted to add?
Yeah, well, Adam outlined it well. I think that it, as he said, and I may be even stronger on this opinion, and that is that I think Powell's going to keep raising rates. He may go from 3/4 point to half and maybe a quarter. I don't think he's going to pivot, meaning come right down. I think that's how I understood what Adam said, but he could just go along at let's say it's a 6% rate, federal funds rate gets to 6%, and just keep it there for a quarter and another quarter and see what happens. My take is that the Powell, that's about the only weapon he has, and continue to use it until it doesn't work. And if something breaks in the system, which it could, then it really doesn't matter at that point. We're back into a 2008 scenario, except it's more massive because derivative exposure is so huge and the interbank connections are so large, and you've got so many entities that don't trust each other. I mean, when you could cut off the reserve currency of the world to the Russians and say this currency isn't any good and create financial warfare at that level, we really have to admit we have to lose faith in the system at large. And that's what's happening with some of these larger financial behemoths outside of the United States.
Right. Yeah, no, that's very true. There's a lot of different factors and a lot of different parts to that. Russell, anything else you'd like to add to that? We're going to go on to another topic, but I wanted to, you have a good way of kind of setting things up. So maybe you can just kind of frame this for investors the way you see it.
Well, I think I'll keep it short. Like Adam, I'm not really a guru. I get a chance to hang out with gurus. I sat on a panel in Belize last June with George Gammon, Chris Martenson, and Danielle DiMartino Booth. And then I sat again with Danielle in New Orleans, and we had a conversation. And I asked her point blank, do you think that the Fed will raise interest rates until something breaks? And she agreed with Adam that yes, he will. And I asked her the follow-up question, what's going to break? And she said, without hesitation, credit markets. David just talked about 2008 2.0. Well, what happened in 2008 was that the bond markets imploded because a very small esoteric segment of the bond market, mortgage-backed securities, started to default. Therefore, the value of those mortgage-backed securities fell. That in and of itself is not the big problem. The problem, as David mentioned, is the derivatives. When you've borrowed money, pledged those treasuries as collateral, and they begin to decline in value because of rising interest rates. I know we have a lot of real estate investors on this because that's what you do and that's what I do. And they get very confused by the inverse relationship between bond yields and bond values, but they totally understand the inverse relationship between cap rates and apartment prices. So if you can imagine that when cap rates fall, apartment prices go up, you can imagine that as interest rates were declining over the last 4 decades, we had a big boom in the bond market, which is the credit market. Lots of money and derivatives of that money, which are when you borrow against one bond to create a new bond, right? And so there's a lot of debt. And so the opposite is true when interest rates are rising, that all of those bond values begin to fall. And when they've been margined, which is, lent against, pledged, or hypothecated is the term they use, then that creates margin calls and a demand for cash. And in the financial plumbing, what I've learned is where some of that demand shows up is 2 places. The dollar gets unusually strong. You say, well, why is there such a bid on the dollar? It's because everybody's having to cash out and cover these margin calls. And it's not just the US, it's global. And so that's one level. And then the other place you see it is in the repo market. And the repo market is like a pawn shop for treasury holders. So these big institutions that have portfolios of bonds and they don't want to realize the loss will show up at the repo market and pledge the collateral to get cash. And to David's point, when they don't trust each other, that risk premium of distrust is reflected in the interest rate in the repo market. And back in September of 2019, we saw that market go from that interest rate, that risk premium go from 1% to 10%. That's 1,000%, 10 times the distrust in the market. So I think the lesson, rather than have everybody try to become a macro addict or geek like, I think some of us are, is just to understand that the credit markets are extremely fragile. And if Danielle's right, and the Fed will continue to go until those credit markets break, if you are in a business, if you have a portfolio, if anything you do depends upon healthy credit markets and you don't have a plan B, you're in trouble. I know because that's what happened to me in 2008. I brokered mortgages. I'd had 0 cash in the bank. I did everything on credit lines. And we built real estate. We sold real estate. Everything was about leverage, and cash to asset to cash was a takeout buyer having access to healthy credit markets. When the credit markets broke, I had no operating capital. I had nothing to sell, and I had no way to move my product. And it was a complete 100% wipeout. That's called single point failure. So the practical, tactical Main Street lesson here is if you've got a healthy dependence in whatever it is you do on healthy credit markets, start thinking about a plan B. And then I'm sure we'll have follow-up conversation on this. The flip side of that is in order to save the credit markets, the Fed may end up having to sacrifice the dollar. And you combine that with the geopolitical pressures to get away from the dollar. Again, David alluded to the dollar being weaponized in this dispute with Russia. If you don't have a plan B for the dollar, that's something else you need to be paying attention to. And so that's new. That wasn't a problem in 2008, but I think it's a real problem right now. And I believe the relative strength of gold in the face of rising interest rates is telling you that people don't trust the dollar as much as they trust precious metals.
So there's a lot of good content there. I think, this is worth watching the replay just for the first 15 minutes here. You talked about getting away from the dollar, having a plan B. I know a lot of us here, are metals or real asset people. And actually, I'm sure a lot of people on this, they're watching this either live or on a replay, either in a real estate, you're into metals, you're into something. What are some strategies that you see working right now that you would say, hey, it's important to look into maybe one of your favorite strategies? Let's start with Adam, just anything, that you're doing or that you'd recommend.
Sure. I've got a list here, but probably at the top of it right now are bonds. It's a very uncertain time in the market right now. And so I think in general, most people would benefit from taking a defensive stance. in kind of de-risking. And what's great about bonds right now, and particularly I'm thinking mostly about sort of, sovereign bonds and US sovereign bonds, US treasuries, is they are now finally paying you, a decent return. So you actually get paid to sort of wait in safety, which is great. And in fact, right now, the bonds are paying you a better yield than dividends and stocks in this market right now. And so I think a lot of investors have been kind of all in the equity markets for the past bunch of years while the Fed was intervening and stocks just kind of hit new highs year after year after year. That era is over, and right now we're in a much more hard to navigate time frame. And so, anyways, the safety of bonds is appealing, and that they pay you to sit in safety. But what's also interesting about bonds is, let's say that the Fed does pivot at some point. Right. So let's say that something does break and it forces the Fed to pivot. The Fed starts bringing interest rates down. What that's going to do is, it's that inverse relationship that Russ was talking about. It's going to cause the price of these bonds to appreciate. So you kind of get this option value for free by sitting in the safety of bonds right now. And obviously, the longer dated the bond is, the higher that impact is going to be in terms of how much it might rise. So I've talked to a number of people. I have money managers who come on my program every week. Not everyone, but all of them have said it's a very attractive opportunity for bonds. A good number of them have said it's the most attractive environment for bonds that they've seen in their careers right now. So,
I want to make one comment on that real quick before you go on to the next one with bonds, because I think that you're absolutely right. I mean, if you look at what happened in 1980, when, bond yields at some point got to 20% or higher, if you had some of these long-term bonds and then rates started dropping, obviously people that hold bonds while rates are rising, that makes bonds worth less. But if you have bonds that are higher yield and then rates start going down, you said the inverse relationship is huge. That's an awesome strategy. What are bonds currently paying right now? I mean, for longer dated bonds?
Well, I mean, so right now we have an inverted yield curve, right? But you can, I don't know, what's the 10-year yielding right now? I mean, a little over 4%, something like that, or actually maybe it's a little bit less than that. But some of the shorter dated instruments are yielding 4.5. So yeah, I mean, compared to what your bank is going to pay you, right, which is basically nothing.
The 30-year mortgage just got over 8%. I think yesterday it said it was actually over 8%, which I was surprised to see that it was that high. I didn't mean to cut you off. If you wanted to add another thing or two before we go around and get.
You know what? I'll just mention a couple of things, and then I'll let David and Russ dive deep in whatever they want to. If you're concerned about inflation, and maybe we can have a talk about what's the bigger monster to worry about here. Is it really inflation, or could it be deflation later on? But if you're worried about inflation, or stagflation, there are tips that are out there. There's a new stagflation ETF. The ticker there is STGF. I think the green infrastructure movement, whether you approve of it or not, there's going to be a lot of capital getting spent in that space. So that's an interesting sector to look at. Natural resources in general, for I'm sure a whole bunch of reasons we're going to talk about here, I think are very attractive right now. But I want to underscore a message that natural resource investor Rick Rule has been out there banging the drum for, which is that yes, a lot of them are undervalued right now. Yes, the many sectors there have kind of cleaned themselves up and they have the best balance sheets that they've had in a long time. But the real reason to look at them is we have been on a secular basis underinvesting in the capital investment and the infrastructure in a lot of these sectors. And as Rick says, like even if demand stays flat from here, which it won't, it'll grow, but even if it stays flat from here, we are guaranteed to have shortages in a number of key commodities over the coming decade because of underinvestment decisions that we made 5, 10, 15 years ago. They're unavoidable at this point. And of course, any additional increases in demand are just going to make that even worse. Obviously, precious metals, we'll talk about that, so I won't even mention it here. And then, income streams, assets that produce inflation adjusting cash flow streams. That's really sort of Russ's bread and butter, so I'll let him really dive deep there. But, if you're worried about inflation and you're worried about, being able to stay afloat in what's coming, income streams that adjust as inflation rises become exceptionally valuable in this type of environment.
Love it. That's great. Thanks, Adam. That's awesome. One thing we talked about ESG, or you mentioned this. There's so many of these. It's like trillions of dollars of fund managers' funds. I mean, it's a high percentage of the financial world has stated they will not invest in things such as natural gas or gasoline for cars or things like this because it's not considered clean. But yet it's just a huge underinvestment, and we don't have the ability to move there. David, talk to us about other ideas that you're seeing. I know you're a metals guy. What are some things in that area, around that area, maybe some other creative things that you're seeing right now that are becoming attractive?
Well, I'll just add on to Adam and make my own statement. Excuse me. If we're going to see interest rates continue to rise, you don't want to be on the long end of the curve. You want to wait until it peaks. So I think the strategy is just holding sovereign debt like a T-bill only fund or something. I wouldn't go out more than 2 years. Although my own daughter asked me about the TIPS, the treasuries that are inflation protected, and that's probably not a bad place to go. She's raised by me conservatively. So as far as what do I do? I mean, gold did nothing last year, but it did better than almost all the other classes because the S&P bonds and real estate didn't do as well as staying even. So I've always been an advocate to have metals in the right amount, and the right amount is a very small portion of the average portfolio. But it does, if you do any portfolio analysis that's objective, if it's an associates, Harvard did one, CPM Group did one, there's others out there, that you do need a weighting in the metals if you want to have maximized portfolio performance, but you don't have to go overboard. I think right now, basically what I'm doing is I'm building cash short term, like I said, and I did get at the bottom of the palladium market, at least it looks like it so far, but like gold, it's fallen off rather substantially here in the last couple of weeks of trading. So I think save, live within your means. I would say this is a little outside the financial thing, but it's on my heart. And that is, if you're in a situation where it's tough, consider what assets you have. I mean, one that I can highly recommend, and it's not very popular, is if you're a 2-car family and one of you works from home most of the time, get rid of it. Get down to 1 car. Start walking, ride a bike. I mean, I'm being a bit facetious, but that's a burden. It's a liability. It's not an asset. You won't have insurance. You won't have to maintain it. And it's just something that the American culture is not used to doing. So I'll leave it there.
Right. So, gold actually, from a US, dollar denominated, standpoint, didn't do super well in 2022. But if you look at it internationally, it did very well because of the rush to the dollar and the dollar getting stronger. So in some ways you could see that it actually did do very well. Russ, what are you seeing? I know you're going to talk, well, just share whatever you want to share. You got a lot you could talk about.
Well, I mean, I'm not a fan of bonds, and that's because of the counterparty risk, and you don't have a lot of exit options. The counterparty risk with the government is they destroy the currency and you get paid back, but the currency you get's not worth anything. So I think as a cash management tool, 30-day treasuries, not bad, better than being exposed to the banking system. If you got a lot of cash higher than the FDIC limits, 30-day treasury is not a bad place to stay liquid. Big fan of metals for liquidity because you can pivot into any currency. There's friction for sure. But again, I think gold has proven itself, to David's point, in a rapidly rising, fastest rate increase environment we've been in a very, very long time. And in spite of that, when all other asset prices were crashing, gold did what gold is supposed to do. And so I was really impressed with that. I think silver continues to be undervalued. I think it's $21, $22 an ounce right now at spot. And even with the premiums, it continues to be well below 50% of its all-time high. And it's been there, I think, 2 or 3 times. David would know better than me, but at least twice before that I know of. So I think that, again, I'm not a cash to asset to cash guy. I don't think you flip assets to accumulate fiat. I'm much more about cash to asset to cash flow. Even real estate, as much as I love real estate equity, I think you harvest the equity and turn it into cash flow, and or more real estate and tax breaks. So real estate gives you the opportunity to use debt, which puts you short the dollar in the long term. It gives you the opportunity to have a inflation indexed income stream, to Adam's earlier point, because rents have proven to be very inflationary, which is bad if you're a renter, but is great if you're a landlord, especially if you've got long-term fixed debt. You get the opportunity to create equity and leverage that increased income into harvesting that equity. You can convert it into precious metals. You can convert it into debt. I like mortgages, private mortgages over bonds. I'm not saying there isn't a place for bonds, but I think you get a better yield and you have more options. If I carry back a note on a piece of property and the borrower defaults, that's my counterparty risk. I get the property. And if I get the property back, I can sell the property. I can rent the property, or I can sell the property on a carryback and generate a whole new note after getting a down payment, which reduces my principal exposure. So I think there's a lot of flexibility, a lot of paper managers don't understand, where you can create some or all and even better benefits using real estate. There was a question that Rick put up in the Q&A, and I actually had this on my list because I just came back from the Vancouver Resource Investment Conference. Bronson, you and I had a chance to have an awesome lunch while we were there, and I think I was the only real estate guy in the room, and I ended up on a panel with Rick Rule. And at the very end, at the kind of the wrap up, the promoter asked us what was our big aha and takeaway. And of course, in the room full of resource investors, I said, well, you know what? My big takeaway is probably not all that impressive to you, but my big takeaway was the opportunity in uranium. I heard people talking and I began to understand why uranium makes sense right now. Adam had mentioned severe underinvestment in the oil sector. Oil just doesn't show up. It's not like the Beverly Hillbillies where, you go out and you just shoot the ground and oil comes up. It takes a lot of exploration, a lot of risk capital to find and develop productive oil. And you see these oil companies with record profits. Part of that is because they're hesitating to make those capital investments because they've got an administration that's hostile to their industry. They've got a global political environment that's hostile to their industry. Now, you may agree from a climate perspective and all that they're right, but at the end of the day, it means that there is going to be down the road a shortage of power because alternative forms of energy, at least as far as green energy, when you think of wind and solar, are just not going to be able to carry the freight. And if you think about it, that probably means there's going to be a play for nuclear, especially as the technology gets better. So uranium is a really interesting thing. I would definitely be paying attention to that. And then I think one of the other things is just to realize that if one of the best things you can have is a great social network. Adam co-authored a book called Prosper, and in it he talks about the importance of social capital. I'm huge on that, huge, because there are a lot of people out there that have a whole lot more money than you do. And Jim Rohn famously said, if you want to do well, become valuable to valuable people. And what's going to happen is if the currency collapses, if the credit markets collapse, if the pressure of rising interest rates creates a recession or a depression, there is going to be blood in the streets. There's going to be deals. And you might say, well, without credit, I don't have the ability to partake. And that's the saddest thing. I remember having a high-rise condo in Las Vegas that I paid $750,000 for. And at the pit of the 2008 financial crisis, I could have bought the same condo for $100,000. But I didn't have 100,000. And what I didn't do was cultivate a network of people. I didn't cultivate a network of people that would want to get in on that deal. I was aware of the deal, didn't have the money. They had the money. They weren't aware of the deal. So I've made it my mission over the last 10, 15 years to be very much in the deal flow and to develop a big network. Robert and I got very involved in the precious metals community because I noticed in 2008, there was an inverse relationship. As real estate prices were crashing, gold was going up. And I thought to myself, I don't know why that's happening, but if past is prologue, I think I want to be well connected in the precious metals world, because if real estate crashes again, people are going to have precious metals and they're going to be looking for the next place to go where we can create income and tax breaks. And sure enough, what have we seen? We've seen real estate prices retreating and precious metal prices increasing. And so I think don't underestimate the value of investing your time. And it's a lot more than, your time than your money. You don't have to spend a lot of money, but build build a great social network of people that are going to have capital in tough times, and realize that you can become valuable to them by bringing them deal flow. I'm a Main Street guy. I'm not a Wall Street guy. And I think that, for a lot of people that are interested in Main Street investing, when you have a good social network and they bring you deal flow and bring you capital and you put yourself in the middle of it, Bronson, I know that's what you do. That's what we teach people in our syndication program. You have a real opportunity to thrive in good times and bad.
Yeah, absolutely. Well, there's a lot of nuggets there. I hope you guys were taking notes from all these three brilliant guys that are, not gurus, but they're some of the people I respect the most in this area. So listen to them. And obviously uranium. I love what Russ said, right? Uranium, social capital, and metals. And then, bonds. There's a lot of different things you can do. So pick what resonates for you and then look into that. So we've talked a lot about opportunities. We're going to get to questions here in a minute. So if you have burning questions, get ready. We're going to, in a few minutes, we're going to run more time, and then we're going to go into questions. But what I really want to talk about is, it's not just making money and having the opportunity to make money, but it's the risk of losing money, right? So let's talk a little bit. We're seeing it now in real estate. I had Ken McElroy on a panel last month, and we were talking, there's a couple of large deals, including a $500 million portfolio in the Bay Area that basically, had to default on their loan, right? Because they couldn't make it. So there's some risks out there right now. So what would you say, we'll start with Adam, but just for the retail investor, what are some risks that you should be aware of right now if you're invested in a certain thing, or you're counting on something traditionally that's always been solid that I'm not really sure if I'd do that right now?
I think that's the risk, right? You got to really look at what your concentration risk is. I was interviewing Grant Williams, who's a great macro analyst, the other day. In fact, the interview just launched on my channel a few hours ago. And he really advises people in this, again, very uncertain market to ask themselves the question, where can I get hurt the most, right? Where am I over-concentrated? Which one of my investment hypotheses am I maybe relying on too much? And if it's wrong, it's going to damage me, right? So, you're talking to greats like Jim Rickards, they've just been banging the drum of diversification here. So one, make sure you're not too overly concentrated. Two, make sure that if you are placing big bets, that you have hedges in your portfolio for your primary thesis on them being wrong, right? So that if you are wrong, you're not wiped out by those decisions, right? So I definitely would sort of start with that look, but look, I mean, my big drum that I've been banging on is, the markets as we've known them have been in easy mode ever since we came out of the great financial crisis, right? They've, for basically more than a decade, they just inexorably went up every year. If there was any trouble, the Fed stepped in, the Fed put was in play, you just bought the dip and you were taken care of, right? So we've basically trained a generation of investors to press the easy button and to expect that the Fed's going to be there to bail them out at any moment's notice. I think those days are over. And the repercussions for that is, I think we're entering an era in which a lot of what worked from an investing strategy is not going to work going forward. So you basically got to switch playbooks. And so if you're playing by the old playbook, I think you've got a substantial risk of really getting into trouble here. And so when I look at kind of the rest of this year, right, what I see as being most probable, this is my consensus from talking to all these people, is that, like I said, the markets are in this game of chicken with the Fed right now. I think the markets are going to lose that game of chicken. I think the Fed probably is over tightening. David was talking about the massive difference we have now versus previous eras in terms of the size of the debts that we have, as well as all the derivative exposure to them. The shock that we've just delivered to the system by raising interest rates from basically the lowest they've ever been in recorded history, as violently as we've raised them within the past year, is akin to basically like throwing somebody into the Arctic Ocean. It's just this systemic shock. And there's a delay of about 9 to 12 months between when the Fed makes a policy decision and when that decision, the impact of that decision is fully realized in the economy. So we are only just now beginning to feel the impacts, the shockwaves of the first rate hikes that the Fed was beginning to make early last year. Those are going to be slamming into the economy over the next 3 quarters from the hikes we've just made, let alone the ones that the Fed's going to continue making from here. So, I think the big worry here is that that could bring the financial markets down into kind of a true bear market, right? We all thought that 2022, that last year, was a pretty rough year for markets. That did not have the hallmarks of a true bear market. A true bear market ends when nobody wants to touch a stock again. We didn't see that kind of capitulation. So I think the probability is not bad that we could get to a point where we have that kind of steep bear market drop. We get that kind of capitulation. In parallel with that, we're seeing profit margins at corporations have been the highest they've ever been as of last year. That's one of the highest or most mean reverting data sets that we have in the world of finance. And we're already beginning to see that the earnings profit margins are coming down. And as they do, companies have to start cutting costs, which is why we've started to see layoffs begin to accelerate from here this year. You combine that with a housing market correction, and I like to remind people that what happens with housing prices is actually much more important in terms of the negative wealth effect that causes consumers to start tightening their purse strings, because financial assets are primarily owned by the wealthy. It's something like 90% of all financial assets are owned by the top 10% of households, but housing is much more widely owned, right? So, what happens in housing really impacts how people feel about their wealth. So if we concurrently have a market correction, a financial market correction, a housing market correction, and then you add in the fear of layoffs where people are worried about losing their income, right? You're going to see a dramatic drop off in consumer spending. And of course, the US GDP is about 70% consumer spending. So that kind of creates this vicious vortex, right? That just sucks everything down with it. When you asked about kind of the risks I see out there, that's my big concern for 2023. And so I think as an investor, you just have to ask yourself, oh my gosh, if that kind of triple threat happens, how exposed am I with my current portfolio?
Yeah, I know there's many threats out there, and I like you talked about the idea of jumping in the Arctic, and I do cold plunging where I go on a 38-degree cold plunge, and it is shocking, but it's actually good for you. So I know you guys should try it sometime. But the idea of even with the markets, I talk to investors about this. People don't realize that stocks are incredibly risky, and from 1929, the time of the crash, which is similar price earnings ratios as we recently had, it took 25 years to get back to that same level in nominal terms. And that doesn't even include inflation. And so it's just like, could you wait 25 years to have, a loss and not be able to go forward? So I think there could be, if one asset drops, it could affect another, and just having different plans is really important. That was great. Thank you, Adam.
Thanks. And that's a great point about the danger of a lost decade. And I'll finish up here, but I will put a link in the chat here to John Hussman is a highly respected market analyst. His latest forecasts show that we are likely to have a negative 3 or 4% return in the S&P over the next decade. So right now, there are experts like him whose models are suggesting we are looking at a lost decade ahead of us. Now, it doesn't necessarily mean that assets are just going to be flat for a decade. They probably will be pretty wild. The ride may be wild. But to your point, Bronson, we may fast forward in 10 years and find out that nominally we haven't gone anywhere.
Right. And when you count inflation, it could even be like the 70s where it went up a little bit, but you actually didn't really make any
right.
money.
Your real returns are actually quite deeply negative. Yeah,
exactly. David, what are some of the risks that you're seeing? I know you're seeing some risks out there. What are some things that have come up for you recently that you're watching?
Well, it sounds like parroting everyone else, but I mean, if you look at what you just said, Bronson, about taking an accurate picture and getting truth into the system, which is probably the rarest commodity these days. But Jim Dimes wrote a book in the 70s called The Invisible Crash. And what it showed was that the Dow Jones Industrial Average in terms of gold was actually in a downtrend. But if you looked at it nominally, it was in an uptrend. So which one's the truth, right? So I'm really hesitant to say anything more than I'm, saving cash and buying some more precious metals. I like platinum at the bottom. I'm neutral to slightly positive. I've been out of palladium for a long time. I think the foodstuffs are very important and energy is extremely important. But I wanted to bring something to everyone's attention. You got me on a roll. The reason I keep looking over here is I have two screens. But we went to the theoretical green-only world where we don't have anything but electricity. We are not using internal combustion engine cars, boats, planes, or anything else. So if we wanted to move to that, we would have to have in copper 6,700 million tons. And at the production rate of 2019, it would take 328 years to get that much copper.
Wow. For
nickel, 518 years. Lithium, 16,000 years. Cobalt, 2,200 years. So you get the idea. And this is another one for the green movement. And I think we should be good stewards of the land. It's not what I'm saying. I'm just pointing out, if you want to go green, you're going to tap the earth 10 times more than you have already. So, so I wanted to bring that out. I'll yield to Russ, and I thought we were going to take some. Well, one question real quick. Asked if the value-added tax would come here for precious metals here in the U.S. No. In fact, the Sound Money Committee, headed by Stefan Gleason, a friend of mine, it's got several states that have taken sales tax and capital gains tax, and some cases state sales tax off of precious metals in the U.S. So the trend here is opposite of VAT being added.
Yeah, wow. I mean, I felt the way about the green agenda. It's I think the thought is good, but there's just not I mean, I live in California where they're saying you can't build a house that has gas heating or a gas stove by 2030, and you can't use gas more. I mean, it just doesn't make any sense. Where's all this electricity? We're already burning coal and natural gas to create. Anyway, that's another topic though. But Russ, what do you see the biggest risk is if I'm an investor and I'm looking at all of these things that are happening now?
Well, I think that the biggest risk is you. I went through 2008 and I thought that the problem was the great financial crisis. And then I became friends with Ken McElroy, who did great during the great financial crisis. And it was my own paradigm. I say all the time, what you think and what you believe affects what you do, and what you do affects the results you produce. And so I had a little bit of a victim mentality, but I also had a way of thinking that dictated my business decisions and my investing decisions. And so I think the most important thing, and of course I'm singing to the choir right now, because the people who are here are learning. For every person here, there's probably 100 people that were invited that decided not to come. So kudos to all of you for being here. And I really think you have to challenge your thinking. Robert Kiyosaki wrote a book called Rich Dad, Poor Dad. If you haven't read that book, you need to read that book. And he challenged some core beliefs, like that your house is an asset. He took a lot of heat for that. It took me a long time as a real estate guy to get my mind around what he was saying. But his basic concept is an asset is only something that puts money in your pocket. His thesis, which is 1,000% right, is that real wealth is cash flow. And so Ken McElroy, who a lot of us know, invested in cash flowing real estate assets, and they continued to cash flow. If you go back and look at the historical charts of what rents did versus what asset prices in housing did and residential real estate equity disappeared. It went down 30, 40, 50%. The pricing did, but rents didn't. And so understand what you're investing for. Cash flow is real wealth. When you have someone who gets up every day and makes a mortgage payment to you because you're a lender, when they get up every day and they pay you rent because you're a landlord, when they get up every day and they use your office space or your industrial space to make a living, whatever it is, you are basically harnessing the efforts of others. And that's real wealth, as opposed to air. Equity, unrealized gains on your balance sheet, that's air. If there's 100 million shares of Apple stock outstanding and some guy pays whatever price he pays, $200 a share for 1,000 shares, every one of those 10 million or 100 million shares of Apple are deemed on everybody's financial statements to be worth what he paid, but they're not. If everybody went to go sell them, that wouldn't happen. Whereas if you go look at an apartment building in a given neighborhood or a set of apartments, you might have 95% occupancy. That means there is a buyer and a seller of 30 days use of that facility, paying and settling the transaction in real terms, full absorption. That is real sustainable wealth. Warren Buffett, famous value investing. He doesn't care what the share price is. He cares what the price to earnings ratio is. He cares what the yield on invested capital is. He's a cash flow investor. He buys real productivity. So I'm just here to say, in an environment of easy money, of a lot of air being pumped in with low interest rates and easy credit and underwriting, it is easy to think you're wealthy because you have a stock portfolio that's appreciated, or a house that was once worth $50,000 that's now worth $250,000. But in terms of real utility, it still only sleeps 3 people. It's not real wealth. Real wealth is cash flow. That's number one. Number two, dollars are not money. Don't save dollars because it's not real money. It's a medium of exchange. It used to be real money when it was backed by real money, which is gold and silver. So use your cash flow to create savings and put that savings into something real like precious metals that you can pivot into any currency, and then go buy real assets like real estate that provide cash flow, tax breaks, which enhance your cash flow, and even better, provide leverage, meaning you can magnify the appreciation by using debt. And so just understand, the investment you need to make is in how you think and what you believe and the people you listen to and what you think investing is, what you think wealth is. And then once you do that, you will start to make better decisions. If I would have thought the way I think today, 20 years ago, I would have not only not been wiped out by 2008, I would have made a fortune. But it took me losing everything in 2008 for me to wake up and realize the worst investment advice I ever got that I believed was buy low, sell high. I thought, boy, buy low, sell high. That's the path to wealth. My goal was to buy low, sell high. And so that round trip generates commissions for the people who sell you the investments. It generates capital gains and taxes for the government. And it puts cash in the bank where you get no yield, and the bankers lever it up through fractional reserve banking and make money off your savings. What do you get? You get a currency they're printing into oblivion and 8% inflation, whatever it is. You get nothing. That's the worst investment, in my opinion. That's the worst investment advice you could get. If you're investing, going from cash to asset, which is cash flow, and then leveraging the cash flow to harvest equity to create real savings in precious metals and to acquire down payments and more streams of cash flow and more tax breaks, now you're beginning to build not only real wealth, but resilient wealth. And then when you focus on things that I think everybody has more or less alluded to, that are real and essential. If you watch the professional money managers, what they do is when they begin to sense weakness in the economy, they abandon all of the innovation. They abandon all of the fluff. They go to the consumer staples. They invest in food. They invest in energy, right? If you want a conservative portfolio, invest in things that are essential to human existence: housing, food, energy, commodities that make the products. You don't care what the products are. I don't need to know what the technology is. I know if that I own the commodity, I'm going to be okay. Right. So it I think just understand that your number one investment, and again, preaching to the choir because you guys are here learning, but encourage your friends to learn with you. Become an evangelist for financial education. It'll help you expand your network. It'll help you expand your knowledge. And it'll make sure that your neighbors aren't voting you into oblivion because they're ill prepared for tough times when they come, right? I don't want to wax too political, but there are people who think when bad things happen to them, it's somebody else's fault. And if you happen to be the person with money, you're the one that has to underwrite their ignorance or bad decisions, right? The only way to fix that is in the marketplace of ideas. Obviously, we're all educators. It's a big part of what we do in our businesses. And we do it in our enlightened self-interest, to quote Jim Rohn. We know the more people that are prosperous in this economy, the more people we have to trade with, the less likely people are going to vote themselves into our pocketbook. So join that army of evangelists for financial education and make sure that you're getting real asset, real world financial education, and don't buy into the buy low, sell high, because I tell you, I did, and it doesn't work.
I love it. Well, there's a lot of nuggets from there. I was taking notes. Buy low, sell high. Watch out for that. Real wealth is cash flow, and dollars are not wealth. Thinking outside the dollar. We're getting some questions coming in now. We've got a few more minutes. We'll take a few questions. A question coming in from Rick. I know, Russ, you addressed this. Maybe Adam and David. Uranium. Just quick, thoughts. Are you a fan of uranium? Do you think that's kind of where we're headed? Obviously, if there's, I think Adam, you talked about it a little bit too. If a country can kind of get something going, give them an advantage. Are we seeing this kind of countries really embrace this?
And I'm sorry, countries really embracing which?
Oh, embracing uranium, getting into uranium.
Oh,
yeah.
And actually, I'm glad you brought this up. So yes, Russ talked a lot about how if we want the world to grow the way that we all hope it will, right, that has to be powered by energy, right? And we as a species have always moved from a less dense energy source to a higher density energy source, right? And that makes a lot of sense. With the move to green energy, it's actually an intentional move from a more dense energy source, hydrocarbons, to a less dense energy source. And look, I'm not saying we shouldn't do it. I'm simply saying we should do it wherever we can get a positive ROI out of it. But I'm saying we just need to be realistic about it. It's not going to produce enough energy units and enough of the type of energy units that we're going to need to power the future, right? So I think more and more people are beginning to realize this. A lot of people are beginning to realize this by kind of slamming into the hard wall of reality. And Germany is a great example of this, right? Where they were focused on decommissioning their nuclear plants. And then they got caught by surprise with the Russia's invasion of Ukraine and the repercussions that happened from that. And, as a result, Germany has burned more coal than it ever planned it was ever going to do again, right? And so it actually had to revert to a much dirtier form of energy because it had been caught flat-footed by its sort of unrealistic transition expectations over to this new green economy. But what's super interesting about this is, it really is uranium's time here. There are new technologies coming out for different types of reactors that are going to be cheaper to build, easier to build, take up smaller footprints, so they don't need to be located, in the critical places that today's plants need to be done. A lot of today's nuclear plants in the U.S. Have been all one-off builds, right? So you don't get this opportunity to develop economies of scale. Well, you'll be able to do that now with this new technology referred to as SMRs, or small modular reactors. And what's notable about that is the U.S. just approved its first design for SMRs in this country. Now, the first SMR probably won't be built and operational for years to come still, but at least the design approval has been granted by the government. So that's a really big milestone. But the most important answer to your question is, have concerns about nuclear from a safety perspective. Now, record of any format measured in loss of human lives.
Looks like we're kind of losing some of your, maybe you can just repeat that last part about safety.
Okay, yeah. So can you hear me now?
Yeah, we got you. You're good.
Okay, great. People are understandably concerned about safety when it comes to nuclear, although it's kind of ironic in the sense that nuclear actually has the best track record safety-wise, even if you factor in Chernobyl and Fukushima and whatnot in terms of loss of human life. But in terms of like the risk-return equation for uranium, Japan, right, shut down all of its nuclear facilities following the Fukushima disaster, right? So this is the country that has lived through the most recent nuclear disaster, and they now have restarted their entire nuclear fleet. They're actually one of the biggest active buyers of uranium out there on the market right now. So, when you talk about sort of like a country voting, right, on whether or not to embrace uranium or not, the country that probably should have the most resistance to it has done the research and is actively now embracing it again. So I think uranium is going to have an extremely bright future ahead of it.
So we're almost out of time here. David, give us your thoughts on uranium.
Yeah, I'm bullish, and I really like the fact that Adam brought up these small modular reactors. I've been an advocate for that for a very long time. So you get rid of a lot of issues with a huge nuclear power plant. You can modulize them and make them like a cookie cutter, make them smaller. You have less worries about radiation and that type of thing because they're contained in smaller units. And if you can just fabricate this design over and over again, put it in production line, so to speak, we could really get with the program. Why this hasn't been done is I've got my own views on that. I won't voice them, but SMRs are the way to go.
Yeah, absolutely. Well, gentlemen, thank you for being here today. We're kind of running short on time. We want to be sensitive to everybody's time. This is a awesome panel, and I just loved it. I feel like I got a lot of take. I took a whole page full of notes. So I'm going to go back and review that. So hopefully, those of you listening, hopefully you got a lot out of this. I encourage you to follow each one of these guys in their channels. They all have YouTube and podcasts, different ways you can follow them. I wanted to just kind of go around and give people a chance to find out what's a way people can get in touch and follow you. If you're interested in following our stuff at Bronson Equity, you'll get an email with a replay of this event. We also have our deals we're doing in multifamily, other sort of alternative asset spaces. We're looking at one in the energy space right now. So if you're not on our deal list, you won't hear about that. So you can find out about that on Bronson Equity. Adam, how can people follow what you're doing, or tell them about your some of the stuff that you're doing, you're working on?
Sure. So real quick, folks, I conduct macro interviews practically on a daily basis. I do 5 or 6 a week. So if you want to watch those, they're completely free to the public. They're very deep dives like this. So if you like long form, hour-long discussions, you're going to love the Wealthion channel. Just go to youtube.com/Wealthion. So I'm so used to doing this on my channel so that I overlay the URL. I put my hand up to do it. But yeah, so you can go to our YouTube channel there. And I just want to also let folks know that we have financial advisors that we've referred thousands and thousands of people to, who watch our videos, who are trying to figure out how to put these insights into action in their own personal portfolios. These people, these financial advisors, they offer free consultations. So they don't cost you anything. There's no strings attached. There's no expectation or commitment that you get to work with these guys after the discussion. They'll literally just sit down with you. They'll do a free portfolio review. They'll tell you what they think you should do. You can take that information, you can do it yourself. You can give it to your existing financial advisor to effect for you. Or if you like these guys, you can continue talking with them. But given where we are right now, if having kind of a second set of eyes from a very experienced financial advisor who appreciates all the macro issues we just talked about today would be of interest to you, just go to wealthion.com, fill out the short form there. Like I said, totally free.
And Adam, maybe you can stick the link in the panel or in the chat there too. People can grab that. David, how can people follow what you're doing and get in touch with you?
Just go to themorganreport.com, get on our free e-letter. And then if you're interested, pull down the subscribe feature, and also get on the blog. From the blog, you can go to all of our social media. They're over in the right-hand side in big icons.
Okay, awesome. Thank you, David. Really appreciate you being here with us today. Russ, how can people follow you?
So actually, we just started an initiative that I'm super excited about. Been doing it for a few months now. And once a month, we do a private virtual investor mentoring club where we talk about real asset investing strategies. And we kind of take the macro viewpoint and bring it down to Main Street. And we talk tax, precious metals, real estate, asset protection. I'm just going to put an email. I've been sitting here talking, not realizing I was muted. So let me start again.
We heard all of it except for just one. So we basically heard it all. I think.
Okay. I'm just going to put this in the chat. So there's an email address in there. If you send an email to imc@realestateguysradio.com, you'll get on our list. You'll hear about the events that we do, like our annual investor summit, where you can hang out with a bunch of high interest people. They're high net worth, but they're also super interested in the subject matter. We bring in a bunch of big brains. But once a month, we do a very affordable program called our Virtual Mentoring Club. And if you send an email to imc@realestateguysradio.com, we'll give you a complimentary guest pass to our next meeting, which happens to be featuring Chris Martinson. And we're going to be talking about the 8 forms of capital. So the timing is good to be here with Adam. Chris and Adam worked together for a long, long time and wrote a great book called Prosper, which if you haven't read, I encourage you to get it and read it. So, and then of course you can find us at realestateguysradio.com, have a podcast every week and have since 1997.
Amazing.
Well, guys, thanks so much. I really appreciate you being here. And also to our audience watching it live or on a replay. the best investment you make really is in your own education. It's really true. I've watched my net worth go up 20x in the last 4 or 5 years just from attending things like this and going to meetups and meeting interesting people. So I just wanted to say this channel is dedicated really to helping you grow your wealth. So next month we'll have a alternative asset investing panel. I believe that will be on March. I believe it's March 15th or 16th. We'll get that information out to you soon, but appreciate everyone being there. Thanks so much for taking the time. And again, this replay will be sent out. Feel free to share it with a friend. Thanks to all our panelists. We'll look forward to seeing everybody soon.
Thanks, everybody. Thanks, guys.
Thanks.
Pleasure to be here, Bronson. Good job.